Hey everybody, Elliot here, Touchstone Financial Education. Today we're going to talk about the interest rate reduction coming as it relates to the bond market and not the stock market. So the way it works is this. There are notes and there are bonds, and that means that there are different levels of maturity. So a note has a shorter maturity than a bond does. And the way the bond market has been working the last 2.5 years is that those shorter term notes, they mature in 1 year, 2 year, 5 year, and 10 years, okay? They've been actually earning more than 15, 20, and 30-year bonds. And that's called an inverted yield curve. And for those of you who like $3 words, it's called disintermediation. I can't say that enough, disintermediation. And let me tell you, it's really paid off for us as consumers as well as investors. And I say that because if you look at your high yield savings account, guess what? You're earning 4.5 to a little over 5%. CDs about the same thing. As for us being consumers, we think the higher interest rate environment is hurting us, but it also helps to bring product prices down. That's a podcast for another day, but know that it has really worked to help stimulate the economy. And now as we move into a different interest rate environment, the economy is going to be stimulated even further. Now, I know they're talking about recession and we might hit one, but guess what? If you're looking to buy a home, finance an automobile, it's going to be slightly cheaper to do so going forward. Again, the bond market is normalizing. The rates are coming down. We will all benefit. Just keep an eye on those interest rates, on those high yield savings accounts, your CDs, all right? But here's the deal. As stock market investors, I know I wasn't going to talk about this, but as stock market investors, lower interest rates means more money going into the stock market than the bond market. So this the stock rally we've seen since 2021, guess what? It's going to continue to expand. So not just tech stocks, but all other sectors of the market as well. We even see utilities returning double-digit returns this year. For those of you who are retired, you might have some utility ETFs, mutual funds, whatever. You're looking at 15, in some cases up to 20% returns, plus that wonderful 3+ dividend yield on those positions. So guys, remember, interest rate reduction next week. It's going to impact us as investors as well as consumers. And if you have any questions, reach out to us, touchstonefinancialeducation.com. Would love to hear from you. Thanks for watching, and until next time.